Everyone is saying that India is the new superpower, about to crush China's economy. But right now, behind these flashy headlines, a disaster is hiding. Millions of young Indians are voluntarily burning their futures without even leaving their rooms. This isn't drugs, and it isn't an epidemic. It's a legal casino disguised as a stock market. How did ordinary mobile apps infect an entire nation with the thirst for easy money? And why could the Indian economic miracle collapse because of mundane trading? The scale of this epidemic was hidden until India's official market regulator, SEBI, published a shocking report. It turned out that 9 out of 10 retail traders in the country consistently lose money trading options. 90%. Instead of going to factories or getting an education, an entire generation of Indians is downloading apps like Zerodha and Grow, taking out microloans at insane interest rates and blowing them in a matter of hours. How did a great economy allow its stock markets to be turned into national roulette? And who is actually taking these people's money? Over the past 3 years, retail investors in India have lost a staggering amount on exchange speculation, around $20 billion. To understand how India broke global anti-records for private trader losses, we need to analyze the country's unique intersection of demographics, technology, and economic history. Under conditions of colossal population density and fierce competition, traditional paths to upward mobility in India have essentially been paralyzed. For hundreds of millions of young people, the physical world and the classical economy represent a solid brick wall. Hard, unskilled labor in construction or agriculture brings in $2 to $3 a day, guaranteeing a life below the poverty line. But even having an education doesn't solve the problem. Thousands of graduates compete for a single entry-level office job with a salary of $200. The labor market is overloaded, and society is still bound by the unspoken rules of the caste system, nepotism, and corruption. Without the right background, connections, or an elite diploma, breaking into a good position is practically impossible. Opening a traditional small business requires startup capital and a readiness to fight local monopolies. Realizing the economic game in the real sector is rigged, Indian youth start looking for an exit. And they find it in the digital environment, where the most tempting and widespread mirage becomes stock trading. Why trading exactly? Because it creates the illusion of absolute equality and a complete absence of barriers. The stock market doesn't ask what caste you're from, who your parents are, or what neighborhood you were born in. Moreover, the barrier to entry here has become extremely low. Thanks to the digital revolution and price dumping by telecom giants, specifically the operator Reliance Jio, the internet in India has become some of the cheapest in the world, about $1.5 for 30 gigabytes of data. To become an investor, you don't need a powerful computer, fluent English, or years of specialized training. The cheapest, even secondhand, smartphone and an installed brokerage app are enough. It is this incredible technical accessibility, set against the backdrop of total social despair, that has turned option speculation into a massive ersatz social ladder. Mass poverty and cheap internet created the perfect breeding ground for a financial catastrophe, but the real catalyst, literally adding fuel to the fire of national gambling addiction, was the industry of so-called finfluencers. The Indian segment of social media saw explosive growth in channels promoting easy money on the stock exchange. Their scheme is built on harsh psychological manipulation. Instead of teaching viewers risk management and composure, finfluencers sell an image of success. They rent supercars, book luxury villas for a day, and flaunt the attributes of a beautiful life, convincing viewers that all of this was earned through day trading. Most of these bloggers don't make money from trading at all. They use special software to draw fake screenshots with giant profits to create the image of successful traders. Their actual income isn't generated from trades, but from selling access to private VIP chats with signals, hawking useless training courses for $20 to $50, or luring people through broker referral links. For a young person from the provinces whose mind is exhausted by daily survival and a lack of prospects, such videos become hypnotic. Staring at the pretty picture, they lose their critical thinking and start believing the secret to wealth lies in buying a paid subscription. The scale of the problem reached such a level that the Indian regulator, SEBI, had to start mass blocking these channels and fining bloggers millions of dollars. However, for every blocked scammer, dozens of new ones immediately take their place, continuing to siphon the last borrowed funds from the most vulnerable part of Indian society. Believing the blogger's beautiful picture, young Indians open brokerage accounts. However, they don't go there to buy shares of stable companies and invest for years to come. Long-term investing seems like a path out of poverty that is far too slow and boring for them. Their main target is the derivatives market, specifically options trading. And here, the trap snaps shut entirely. Indian retail trading has unique and extremely dangerous specifics. The absolute majority of private speculators trade so-called 0 DTE, 0 days to expiration contracts, options on the exact day they expire. The mechanics of this financial instrument are simple, but mathematically ruthless to beginners. On the last day of an options contract's life, it costs mere pennies. A trader can buy it, for example, for just $5. If the market doesn't make a strong, directional surge by the end of the trading session, this contract becomes worthless. The person completely loses their $5. But if there is a sharp market spike, that $5 contract can multiply in value dozens of times in a single hour, to $50, $100, or even $200. To a poor Indian youth, this math looks flawless.
He doesn't think in terms of financial planning, but in terms of desperate hope. $5 is just the cost of a couple of lunches. But if I get lucky, in 1 hour, I'll earn as much as my father makes in a month of hard labor. Having bought such a ticket once, he buys it again and again. The math of options is ruthless, and when brokerage account savings are wiped out, the psychology of desperation kicks in. Unwilling to accept their losses and hoping to win it all back, millions of Indians start looking for additional funds. Mass gambling addiction triggered an explosive growth in unsecured lending in India. Young people, having watched enough videos about overnight success, began taking out consumer loans, microloans, and even borrowing from illegal loan sharks en masse. The situation became so absurd that the Reserve Bank of India was forced to intervene. Central bank analysts discovered a frightening trend. A colossal share of consumer loans, which on paper were issued to buy appliances or for home repairs, were actually being transferred directly to brokerage accounts and burned in daily expirations. In an attempt to cool this fervor, the RBI strictly tightened the rules for issuing unsecured loans. But did this stop Indian traders? No. They found a workaround that shocked even seasoned economists. People started taking out loans against gold. In India, this isn't just an investment asset, but stridhan, sacred family property and dowry passed down through generations. Pawning family gold for the sake of options is an indicator of the deepest social crisis. The correlation is obvious. Over the past 3 years, the number of retail traders has grown by 125%, and the volume of loans secured by gold has increased by 75%. People are literally pawning their family histories. The Securities and Exchange Board of India, SEBI, formulates the main threat. Citizens' savings are going toward speculation, not capital formation. In a healthy economy, citizens' money is invested in the shares of real companies, financing factories and IT startups. But in India, $20 billion simply burned up in daily expirations, settling as broker commissions and hedge fund profits. Authorities are trying to stop this money-burning conveyor belt. They are raising taxes on trading and increasing the minimum lot size to artificially cut the poorest players out of the bidding. However, this is just treating the symptoms. Until the economy can offer millions of young people real jobs with decent pay, the stock market will remain not a tool for multiplying capital, but the only accessible casino for them. A casino where entry costs pennies, but the ultimate price paid is ruined lives. That's all I have for now. If you enjoy these videos and want to see more formats like this, be sure to subscribe to the channel, leave a like, and share your thoughts in the comments.